Okay, folks, welcome to Monday, the 20th of September. It's about 8:42 a.m. here in Dublin. And, we're seeing quite a few different things happening across the markets. We've had quite witching Friday just gone. And now we're waking up to essentially these equity markets down about like 1.8% on DAX, down 1% on SPOOs, which is the S&P 500, 1.3 down on the Dow, and let's see, what are we down on the Nasdaq right now? So we're down, about like 0.8%. So a thread of conversation that I've been looking at and talking about over the last really month, and in some cases, in a greater aspect, I've been talking about this over the last 18 months, is energy shock inflation. Okay. And while the markets have been wholly focused on the inflation story caused by supply chain logistics and sort of a crumpling of that globalization concept, and the streamlined global, manufacturing and delivery picture being disrupted by COVID and restricted workforces and what have you, that's been one inflation picture that has had its push to the upside. We do have very high inflation readings, which is populating the color on all media for the last 8 months, I would say. And every FOMC meeting, as we have this coming Wednesday, really the conversation is about what's the Fed going to do about inflation, and it is now sort of running hot. Um, Double the figures of what the Fed have said that they would be comfortable with. It's running at levels that they said they would be comfortable with it moving to as a peak. But really, for me, I've been holding this concept that that's all fine and well, and I understand that. However, there is a more looming picture, and that is energy prices. And so, really, going back to videos I did with Amplify, you know, uh, like 18 months ago about the impact of like negative oil prices, why we went negative on oil prices, and what we should expect from that. Well, this is sort of the theme that I'm coming back to now. After we went, negative on huge supply glut, left really in storage from the initial impacts of wave one, two, three of COVID in the Western world, and the impacts that even into Asia and South America. Yeah, sure, we should go to net or below zero on oil. That all made sense, right? But it's the aftermath, longer tail picture that really has me married to this concept of energy impact inflation. And so, what do I mean by that? Well, natural gas, for example, and oil are components of manufacturing and shipping, right? And when we had the incident on oil in 2020 around April, May, going below zero, a lot of the integrated big oil companies just got out of the exploration and production business altogether. Now, with that, you have a bad picture. You have a price shock coming because the energy industry has to maintain a certain level of continual year-on-year investment just to meet natural inherent demand, not even to account for rising, guaranteed year-on-year rising demand of some sort, right? And I don't think we're in this world yet where everyone drives a Tesla, and everyone has net carbon neutral footprints, right? That's just a Western world dream. Okay. And it's a worthy dream, and it's where we're going to, and it's where we should get to fast, but it's not happening as fast as people would expect. So let me bring it back to energy inflation shock. Okay. Natural gas is one of the components that I'm pretty interested in at the moment, because if you have reduced exploration and production in oil and gas, therefore you have less producers out there. They're sensitive to leveraging back up to highly geared finance positions where they're borrowing big on low interest rates. They can borrow right now on very low interest rates, historically low interest rates, but they know that they're not borrowing today and paying that loan back tomorrow. They could be borrowing today and paying that loan back over the next 5 to 10 year horizon, where we may see a shock on interest rates to the upside. Okay, we can all understand that. So the point is that there's an inherent risk of severely reduced supply there, okay, for nat gas. So what have the Russians done? The Russians have come out over about a month ago and said, you know what, we do export a lot of gas, but we actually think we need some because there's a winter coming and we don't think it's going to be that warm. So therefore, we're reducing exports significantly and we're keeping it for ourselves. So what has happened has we have seen is that we have seen I think it's almost, well, it's 80% increase in the price of Henry Hub nat gas. And now we can go over to the chart, right? But the point, before I go over to the chart, is the point is that really, if there's anything to take away from this conversation, it's that there is another inflation shock a coming in my mind, and it's going to be driven by much higher prices in energy, oil, and particularly gas. Gas is used in so many in the manufacturing of so many household items, and particularly food items. Okay, both in America and in Europe and in Asia. Okay, so what are these household goods producers and food producers going to do with higher costs of doing business? Well, they're not going to take a bath on that. They're going to pass that on to the consumer. And as a small business owner myself, uh, I clearly understand that there are certain price increases you can absorb as a provider of goods or services, and there are ones that you simply cannot. And the shock coming through from gas as an input cost of your production of your goods is not something that you're going to be able to absorb and take a bath on as a producer. So let's move over to the charts now, and let's have a look at nat gas, right? So this is what we normally look at day on day. Each of these markets, if we got euro, cable, gold, the DAX, Germany, the S&P 500, the Dow, bonds, Tinos, WTI, uh, and the dollar index. But let's get over here and have a look at nat gas on. This is actually a weekly bar chart, right? This is a weekly bar chart. And what you can see here is really quite interesting, right? So let's move in here. Over the last really 5 weeks, you can see the inflection point that came in when Russia decided to reduce its exports, right? And sure enough, there's a little bit of a longer story here, in that back in December, right, back at this point, there was a cold front moving down towards North America from Greenland. And really, over the space of a weekend, there were a lot of traders, myself included, loading up on longs in nat gas, expecting cold snap to be quite pervasive across North America for December, winter 2019 or sorry, 2020 coming into 2021. And then over the course of that weekend, that cold snap took a hard swerve to the east and just dissipated out over the Atlantic Ocean. And so a failed a failed kind of consolidation bid. We didn't even get into this kind of springtime stuff here on Nat Gas. It was really going back into, you can see this sell off here on this week was really what had happened there. But sure enough, the bid was picked up back again, for building up supplies. And sure enough, then we've held this area and gone bid. Now, we have been looking at a couple of Nat Gas equity names in the room in Duggan Capital now. Do check us out, duggancapital.com. But really, you can see now the Russians, once we got up into the highs that we saw in 2020, in around $4, That should have been one and done, and we sort of should have stayed around here. And now the Russians constricting their exports, we've now gone crazy bid back up to levels that we hadn't seen since the very start of 2019. $5 not 40 $5 496 per BCF. So, or BTU, I think it is. So, uh, looking at this whole picture, right? I mean, this is interesting to see that inflection, and sure enough, I mean, nat gas prices have been rocketing, and very hard pullback last week, but that was entirely to be expected out of a pip into this support or resistance area now, still acting as resistance on the market. But I would say we're going to consolidate on the 2018 area here, like the summer 2018 area around $4.74. But one thing I wanted to note was all-time highs. So we had the all-time highs put in 2011 here, and that's fine. This is really due to the US. Sorry, this is a Euro chart. This is really due to in the US up up until this inflection point here in 2015, right? Up until that point, the US had very much been in a pretty bad situation in terms of nat gas. They were a net importer of natural gas, and because of that, prices were pretty elevated. So $10.418, right? And then we sort of had a couple of other geopolitical situations happen here. We came off in price, but what happened in 2015 was way more important in that at this junction in time, there was a company looking to create a regasification terminal in Florida because the US was importing so much nat gas from places like Qatar at that time. And so this terminal was to receive imports, regasify them, and then and distribute them across North Continental America. But up until this point, that was the plan, right? And you can see the bid maintained back again from 2012 back up to 2014. And there's a certain amount of global financial crisis wash happened here on the price coming down. 2012, there was an oil situation really going on there too. But what happened here was that company was then asked by Shell and a lot of these bigger oil companies, what you would call fully integrated oil companies, and in the industry they're called the marquee companies. This importing facility was asked, can you actually liquefy US gas for export? And so the price coming off, and so that's what they did. And this is it's at this point in around 2014 going into 2015 that company was actually granted an export license for US natural gas by the Obama administration, I think it was. And you can see the price shock that was felt across natural gas since then. And that's why we've been trading so low. All right. And I just want to be able to tell the story of nat gas here leading up to kind of where we are, in 2020 now, or sorry, 2021. Um, but you can see that price effect, or the effect that had on price when the US became a net exporter. And this is all largely driven by, net importer to a net exporter because of the shale and fracking revolution. Okay. And so the US drillers really found that there was an ocean of natural gas under the Bakken, under the Permian Basin, Eagle Ford Shale, all these great places in Texas and around Oklahoma as well, and indeed South Dakota also. So you can see that the price shock to the contract was massive, right? But now look where we are. We are under a much bigger geopolitical macro event now, in that Russia is tightening up. So what are the other effects from that? Well, the other effects from that are, guess who buys a lot of Russian gas? Uh, Europeans. There's gas pipelines going from, uh, I think it's Georgia, and the in and around that sort of southern western Russian area through Turkey and up into Europe, right? And look, I don't think that Russia is going to maintain this for more than the coming season. But Europeans are now faced with importing a lot more gas from the US than Russia. Now, the Nat Gas contract you're looking at is the Henry Hub Nat Gas futures contract. So this is Nat Gas produced in North America and sent to a destination called Henry Hub in New York for export. And so that's why you're seeing this natural gas contract on the bid. We saw in and around this period of time back in December, January, February, March this year, you'd see in places like Japan and very isolated areas in North America where they have a very specific blend of gas that trades on its own contract, and you saw like 1,000, 2,000, in some cases 3,000% increase in price. While Henry Hub here just absolutely did nothing because largely this is looking at exports, right? So you can see now what's happened with Nat Gas, and you can see now should we start to push back above the 5.496 level, this is going to have like serious impact for producers and for manufacturers around the world. In Europe, I think in Asia it's not going to be as bad because Qatar is servicing those areas. The Middle East is well servicing parts of Asia, but there are contracts where North American producers are actually exporting to Asia as well. And we do know the Asians do love their commodities and soaking them up and making sure that they have plentiful supply. So yeah, just something on Nat Gas there. I mean, looking across at oil as well on the bigger picture. We'll get that up now. So just get my euro back up, and then we get oil. This is the weekly chart on oil as well. So really looking all the way back to 2015 on the hard left of chart, you can see where we sit now in the oil picture. We've been essentially at this point, we're trading the November 21 contract right now. X21 is the futures contract right now. It's front month, where the most volume is traded right now. And you can see we've been just tearing up out of I think the low that this contract traded back in last April was about $10, right? So this was very much a future calendar product last April, right? So you would have had traders working the curve and like holding this contract into expiry and even further dated contracts. You'd have people trading the Z21. You'd have people trading the Z22 contract back in 2019 and holding that through this move. But essentially, you can see here that I think for me the biggest element of this chart is to note, and don't mind the chart, the graph on the bottom, but is the breakdown or the push above on this trend down that we've seen from the high, the 23rd week of the 23rd of June 2014, and the high of the week of the 1st of October 2018, and then coming into play there in January 2020, pretty much marking a lovely resistance point, and then we had the COVID situation. So, we broke out over that area on that trend in March this year, didn't really hold it, took until about June, late April, late April to then hold and go bid up into that 75.74s level, which is all important, and we have come down from that. But we're now back up again, and I think, sure, we can pull down to like 67.12s even in this contract. I mean, hell, we could even pull down to like 58s, but by and large, we're going to see, to my estimation, $89.77. I think it's high potential that we could see that this year. But really the more prudent target, I think, is the 75.74s before end of year and maybe even $80. Okay. Because simply put, there are no more producers in the game. So just wanted to make everyone aware of, the energy picture as we come into what I think is going to be another bout of more lasting inflation than the Fed have pegged. And so, yeah. All right. Any questions or queries, you can reach out to me, tim@duggancapital.com on email. You can also hit me up on Twitter. It's at TimDug, TIMDUG. And yeah, or you can join our trading room live where we look at all these things each day, 5 days a week when the markets are trading. And yeah, so stay safe out there and go and get some gas for the cooker ASAP. All right, cheers.